webinar today. I'm very excited to have this webinar here for everybody. Good afternoon to our East Coast team. Good morning to our West Coast team. And let's be real, happy lunchtime to those of us sitting in the middle. I am Joey Kinney. I am part of the Summit VCFO by Anders team. I'm joined today with a couple of my colleagues, whom I'm going to introduce here in a second. We've got a couple of quick little housekeeping items that I just want to touch on before we start the content. First of all, this is an interactive webinar. There's a Q&A section down below for anybody to ask any questions you may have or things that you would like for us to talk about. Please use that. We'd love to hear from you. We'd love to be able to answer some of your questions in real time. And if there's a couple of good ones here that are better for, maybe for us to kind of build into the content and talk about with the group as a whole, we'll probably stop the presentation for a little bit and answer those live. Otherwise, I can respond to those directly to you as well. So we'll kind of play that by ear. One other thing as well, if you happen to see a poll down below, I don't think we're going to do any polls, but if there is one that we do need to do, we'll pop it in through there. I think that takes care of all the housekeeping items. So I'm going to introduce our two lovely hosts. The first one here, I'm going to kick it over to you, Hannah.
Thank you, Joey. I'm so excited to be here. I'm a virtual CFO with the Summit VCFO by Anders team. I'm located in Tupelo, Mississippi, and I'm excited to do this with y'all.
Our second guest is Tom Waddleton. Tom, would you like to introduce yourself for a second?
Yeah. So I play the same role that Hannah and Joey play. So I do have a group of business clients. I act as their consultant, often in the capacity of CFO, sometimes in the capacity of controller. Good song choice, Hannah. I feel more awake now as we've done that. So I want to go ahead and jump into our content today. So what we are talking about, if my slides will change, there we go. So how to future-proof your business. And so we're going to talk a lot of different things today, but I think that as you look at this kind of newspaper theme, this hurricane is a great way to look at it. We are in hurricane season. There's actually one that's in the news right now that everyone's talking about. And what we often see with hurricanes is it's big, it's getting bigger, it's going to hit. Many times people prepare and it doesn't hit at the same time you need to prepare. And we'll talk about the benefits of doing that preparation. Recessions often are the same kind of thing. Are we in one? How bad is it going to be? All of those things, and the preparation that's needed really is important. So if we jump into what kind of things we suggest for people, there's a very important rule. You can't go broke with cash. So it's easy to get focused on oftentimes the wrong things, whether it's I should say wrong sort of in quotes, the things you don't need to focus on as much as cash. Do I have the right customers? Do I have the right team? Where should I be looking for savings? What might happen? What are the different pieces of advice? Cash is the oxygen of the business. If you have cash, it allows you to be able to make choices and have flexibility. Without cash, you're very limited in what your choices are for that. And it's so important, we're saying rule number 2, see rule number 1 for that. So can't emphasize this enough. You will see some things in our recommendations and advice that we give that relate to cash specifically. So more than just saying it's important.
Feels a little bit like Fight Club, Tom.
Is that right? In what way?
Oh, it's just rule number 1 about Fight Clubs. You don't talk about Fight Club. And rule number 2 is see rule number 1.
See rule number 1, love it. Okay, so this chart, there's some really good research, and the really important thing is how some companies did recover faster after the Great Recession. So the blue bar, you're looking at resilient companies. The yellow bar, you're looking at the non-resilient companies. And if you look at that downturn in 2008, sitting right here, you can see coming out of that, a year later and then 9 years later, just the difference with where people were in here. So starting at 100, growing by maybe 50% versus up 3 times as big. I'm hoping people see that there's an opportunity here to say, okay, you can come out of this really strong and even probably stronger than you were coming into it. The next chart tells a similar story, but the one thing I really like about this next chart, if you look again at this 2008 time period, you're watching both companies drop. In that next year, these sort of unprepared companies dropped significantly, while in that year of recovery, the other companies were actually starting to do better. They were actually growing during what people would have called a recession. To me, that's a huge message, because people who are prepared can take advantage of opportunities are there, while many people batten down the hatches and say, we're just going to sit back and not let things happen. Others get really aggressive. And then you can see how it takes off. right? They both started an index of 100, and one is all the way up about 8, and the other, so many years later, 7 years later, is in about the same places where they were for that. So I'm hoping people are saying this isn't just about surviving. This is about coming out even stronger after. And again, if you use the hurricane analogy of saying, what if you were prepared and all really ready with your company in good position and the recession didn't happen, then you're in a great position to continue growing.
Yeah, that's the thing. I think when people think about weathering the hurricane, they only think about the downside. And what we've been talking about, not just in preparation for this, but in practice with our clients, is it's a two-way street where you've got to also be prepared for the upside, and it's good to prepare for the good as well as the bad.
Yeah, that whole idea of future proofing. So as we talk recession, Hannah, what are your thoughts? So now that we've said, sort of, you got to be prepared at any time, are we coming into a recession, or what are people thinking?
I actually think that we might sidestep a recession, and we're going to talk about some of the elements that lead me to believe that. And this is one thing that I really hope that y'all walk away from this section of the state of the economy with, is just at least some education, because I feel like, as we all know, everybody's got an opinion. And whenever you're reading articles and you're looking at things of what economists say, a lot of these are opinion based. And yes, they're looking at some lead indicators that are happening in the economy, but I want y'all as business owners to be able to look at these indicators and make decisions for yourself and know how they apply to you as a business owner. The first one of those is the inverted yield curve. Okay, so I promise I'm going to try not to put everybody to sleep with Econ 101 here, but we are going to at least talk about these words that you will see whenever you're reading articles about the economy, and to understand how they apply to your business. And the first of these is the inverted yield curve. So what this means is that short-term bonds and securities are yielding a higher interest rate right now than long-term bonds and securities. So we've seen this happen over history multiple times. A lot of people want to say, okay, well, when does that happen? How much time do I have to react? And you really can't make a prediction looking at this alone. Like a lot of the pieces of what we're going to look at, you can't make any decisions for your business based on one particular piece of the economy. You've got to look at it as a whole. So while, yes, we have an inverted yield curve, and typically that does signal the potential of a downturn, it does not always mean that. So the shortest time frame we've seen in history is about 6 months for whenever we've seen this start to happen. The longest time in history has been about 24. So all of that to say, as long as you're prepared and know what you need to do should X, Y, and Z happen in your business, whether good or bad, I think you'll be perfectly fine. But the inverted yield curve is one thing that economists do look at as a part of this.
It sounds like, Hannah, what you're also saying is it's not if we're going to hit one, it is a when, right? You got this,
absolutely,
this time frame in between.
Yep, absolutely. The next piece of this is decline in the money supply growth. So what this means is the money that's circulating in the economy. How much is circulating in the economy? Right now, we've seen a decline in how much money is circulating in the economy. We've seen less discretionary spending happening right now. We've seen people, if they're making choices of products, they're choosing the lesser value of those products. So they're holding close to the money. And I think we've probably seen this in our businesses as well. Whenever you see this and feel this in your business, you're likely feeling it in the sales cycle. You're seeing this start to extend and people to take more time making those decisions. And maybe they're choosing the lesser of whatever you've put out and proposed to them in the RDP process. Maybe that's what they're choosing. So this decline in the money supply growth, again, is only one piece of the puzzle. We can't look at this in an isolated viewpoint. We've got to look at it as a whole and how it applies to the state of the economy. The next one is, go ahead.
Quick question on that. Do you think that's where a lot of our businesses are seeing kind of the uncertainty of around their pipeline, is where they're feeling that the most, where just people, businesses, but their customers are more hesitant to commit themselves to funds now? Is that kind of where we're seeing that practically come through?
Yes, absolutely. That is one way that we've seen that. I think we may continue to see that for a while longer, at least until we see some of these, kind of speaking now to the lead in economic indicators, until we start to see a shift in that. We may see that still extend for a while. That does not necessarily indicate a recession. It just means that you've got to plan for that accordingly as a business owner and understand what that means for your business and your sales cycle. So just like in our business, we have lead and lag indicators. The economy also also has lead and lag indicators. Some of those leading indicators can be GDP, consumer confidence index, and like the yield curve, like we talked about. So all of these things play into what economists use to predict how the future is going to play out, whether good or bad. And so again, I want you as a business owner to be able to hear these and understand how they apply to your business. The next one is another key indicator is negative GDP growth. So whenever we see negative GDP growth, this means that the value of goods and services has decreased over the course of time. And it means that people's real incomes and standard of living might be lower than what we've seen over the course of time. So we've seen negative growth compared to the average growth for the gross domestic product. So again, another indication that people are holding on to their money. They have less of it to circulate into the economy right now. So all of that plays a role in what we see in our businesses.
Yeah. And the actual definition of recession is two consecutive quarters of negative growth, right?
Yes, exactly. A 20% surge in unemployment claims. Again, this is another piece of the puzzle is whenever we look at what the unemployment claims are. Everything I'm reading right now, though, is that we're actually seeing an upturn in this, and unemployment claims are actually dropping. We've seen a low over the past few months. I think 3.8% is what we ended the month of August at, which is lower than it has been in a really long time. So that is another piece that has me thinking that we might not be as close to a recession as we think, as long as we have a really strong labor workforce and these employment claims continue to go down. But again, that's another word that you probably have heard in the news and a number that gets tracked over the course of time that does play a role into the state of the economy. And employment trends and falling, unemployment and employment trends are falling. So this just plays again that role in understanding how many people are unemployed. And again, if somebody is unemployed, they have less money to pump into the economy. So all of these things is a domino effect based on this unemployment number and why this plays such a role in terms of what we plan to see in the future for the economy. And then the last one, especially as a business owner, you've probably felt this, especially if you've had to go to the bank and talk to them about money of some sort, whether it's a lending situation, a line of credit situation. Banks are really a lot less willing right now to loan money. They're actually looking at how much money do you have in the bank in your deposit products. So if you're going to them and talking about, hey, I need to get a line of credit, they're looking at, okay, well, how much money do you have in the bank right now? Like what's that situation like? And I know Tom's going to speak to this a little bit more too, but it's always a good thing to have a line of credit when things are going well, because when things are not going well, it's a lot harder, not just in your business, but in the economy too. It's a lot harder to get that line of credit whenever you really need it. So it's really important that you're set up for success in this way.
Yeah, very much. Part of being prepared is having that in good shape.
Exactly. Now, obviously, recession stands out to me on this business cycle model that we have here, and that's the low point of the business. But one thing that we really want to focus on specifically in this webinar is how do you prepare for the future, even in the peaks as well, because that can also be a part of this business cycle. Clearly, we've seen that. Tom spoke to that as well. So we want to prepare you for the recession. That's obviously a part of future-proofing your business, but also planning for the upturn as well, so that way you can keep up should we start to see these upswings in these different pieces of the economy is super important.
Thanks, Hannah. And Tom, we could probably move forward to the next slide as well, because what we've done is we've kind of set the stage for what I'm kind of hoping is more of a conversation amongst the three of us to talk about, well, we've defined what it is, but what are some very specific action plans, and what does this look like in terms of creating a plan, you know, for the business and making sure that everything is squared away? Like, what are some practical things that you can do? And we don't have a slide for this yet, but I want to start with number one, Tom, because I think that's the most important one. I tell my clients all the time, there's two P's that you can have in this situation. You can panic or you can be prepared. And there's a very, very big difference between those two P's. When you think about not panicking, this is both for Tom and Hannah, what do y'all think of?
Yeah, for one, let me make a point initially, the purpose of this. So
Mhm,
whether you are a leader in a company or in our role where you're guiding someone,
mhm,
people believing that you have a plan and can get through this is so important to getting into that. So if you're the leader of the organization coming through there, everyone's watching you for this cue, and they're
mhm.
watching for signs, especially in these times, and they're reading into different decisions that happen. And so for me, that's one of the important reasons is you need to be able to project calm if you're going to keep your team focused and working toward getting yourself really well prepared.
Mhm.
It's a lot easier to have that posture when you have a plan as well, in terms of
Mhm.
how you present the information to the people within your organization.
Well, I think what we'll find too is that part of the planning involves some of these other steps. Like it's an all-encompassing, almost like a capstone type thing for a business leader is
Yeah,
gathering the information and setting up systems and processes to be able to handle this. So we probably move along to the next slide
sure.
here and start talking about cash because I think to your point, rules number 1 and 2 have to do with cash.
Yeah, so the first is something we guide all businesses that you should have between 10 and 30% of
Mhm.
1 year's revenue in cash. And if you don't have that currently, working toward that is important. If you really think you're coming into difficult economic times and you have the 10%, you should have more than that. As I mentioned before, cash gives you flexibility. So building up that cash in your business is really an important piece of having that plan put together.
So a quick question, do you view all cash the same or do you view certain cash as different than other cash?
In terms of reserves, having tax reserve, operating reserve, and other cash is in there. I mean, I would say
Mhm,
cash itself is cash, but saying
mhm,
I've got these different categories, I know how spend is going to come together. I do.
mhm.
That's how I think of it.
Yeah. One thing that I've found helpful is kind of segregating that tax account because assuming
Yep.
that that is spent so that you're not also inadvertently spending your tax reserves on the company retreat or whatever it is that you need to do
Sure.
to keep things going. But I do think that 10 to 30% that's a very wide metric.
It is.
What sort of things would lend you towards whether 10% is the right area to live or 30%? What are some of the indicators of that?
I can throw out a couple, and then Hannah, if you want to add to that.
Sure.
So one of the simple ones, the 30% is a riskier business and 10% is a less risky
Mhm,
business. So if I think of just to my customers, the amount of retained, well, let me go to the riskier side. I don't have very much retained business, which means I have to go out constantly and find new projects.
mhm.
And if I have a few customers that make up a very large portion of my business, so any one of them that says no really hurts my business. Those are two different things I would say that have you toward that riskier 30% number.
Mhm.
Yep. And I would say on the spectrum of the 30% as well, you're going to see higher AR days as well in terms of how long it's taking you to
Mhm.
collect your cash versus on the
Mhm.
10% less risky side, you've got really low AR days. Another piece is the age of the partners that are in your business as well in terms of in the riskier side. Do you have people who are retiring really soon or do you have people on the 10% side that are really invested in young and are going to be here for a while in terms of growing the business as well?
Yeah. One other I might throw out is just the number of owners. If you
Mhm.
have one owner, it's really easy to say, I know the direction I'm going. Multiple owners just brings in the piece of someone saying, I want to go a different direction. Maybe even I want to redeem my shares and you're going to have to buy me out. But it may also be, I'm not buying into what this plan is. It just introduces risk to the company when that kind of thing happens.
What are some things you're looking at, not just in cash, but taking a look at the larger picture of overall liquidity in terms of determining what that looks
Mhm.
like? I know
Hannah
one thing
already.
I love to do is kind of take a look at deferred revenue. If you've got someone who's got a very big balance sheet item, we've been prepaid for a bunch
Mhm.
of stuff, we've got to hold on to that cash because we're not getting any more in the future when we start working on some of those projects. So what are some other things around liquidity
Yeah.
that are important to factor in?
Yeah, I would say also WHIP as well in terms of knowing what I've
Mhm.
still got left to build, what my credit card liabilities are, or any of
Mhm,
those liabilities realistically. I mean, whenever I'm talking cash with a client, we're looking at liquidity position as a whole and that change month over month.
mhm.
What did our cash actually do? Because I feel like that in and of itself tells the story of where we're at and where we need to be as a whole in comparative to what our cash reserve goals should be.
Yeah, I agree with you. And if you're talking about getting a handle on looking at your AR collection, and if you're not very good at collecting, getting that in order, both to get the cash in the door, but also have an ongoing process. I mean, collections really is a squeaky wheel kind of a thing. And if you're in the mode of your vendors know, or I'm sorry, your customers know that when it's late, they're going to be getting a phone call, you tend to be the one they pay first. And when things get tight, other people start extending terms, and we'll even suggest that as a piece of advice. So keeping yourself from being the one that everyone's extending because you're the nice guy means cash is not in their bank, or not in your bank, it's in theirs.
We used to say in a different consulting life of mine that collections is a responsibility of the entire office, in terms of making sure that the money's coming in. And if you've got a person on your team who's really, really good at that, and I happen to have one in an old job before I joined the Summit Anders team, that's the most valuable person in your organization, because I didn't have to think about it. I just knew that this individual was going to take care of that, and it was a very, very nice thing to have in the organization. And I love to see when PMs get involved in that, because they have the relationship with the client. What are some other types of strategies for, outside of being the squeaky wheel? Is it just getting PMs involved? Is it getting, what are some ways to decrease that cycle of having those receivables lag?
I think another piece is just having a structure around this, that anybody at any given time can step in and play their role and know where they're at in the collections process as well. Having something that they can duplicate between each client, not something that has to be a one size. We do this for this client, but we do this for this other client over here. And making sure that we have consistency across the board is something I really like to be sure that I see with my clients.
Kind of systematizing that process so that they don't have to content switch as much. They can just rock and roll from that perspective. I like that.
Absolutely.
I agree with that very much, Hannah. And also what I would add is early on, if you have customers that are paying you multiple times, so maybe over a year, they're going to pay you every single month. When you first engage with that customer, making sure that the payment's done correctly. So if they're late on that very first payment, you treat it maybe a little bit differently than other customers to set that tone that we're serious about collections. And we've encouraged many of our customers to have a work stoppage or a work pause clause within their contract. And so then you got this threat of, hey, we're going to stop the work. And what I've often told my clients is make sure they communicate, when I stop the work, I'm reassigning your resources. So if you turn around and pay me immediately, it may be as long as, and they can tell them 6 weeks, tell them 8 weeks, something that's painful, and not just feel like, okay, so you'll disappear Friday, I'll get you the check over the weekend, and you'll start back on Monday. To do that. And then early on in the engagement, if it happens, like the second month they're low, go ahead and pause the work and just let them know how big of a deal this is to do. Just get people on the mode of, we'll do the work on time and you're going to pay us on time.
We had one more thing that I wanted to talk about on cash, and you kind of alluded to it earlier, is the importance of that line of credit within that structure. If you've got a client who doesn't have a line of credit, and we identify that during an onboarding, where do you usually go? What's your starting point for that conversation and starting to solve that hole in the system?
I know for me, I've had clients who try to convince me that they don't need it. And I've actually had a client who they did get into a situation where now they do absolutely need it. And they are so glad that we went ahead and initiated that conversation when their business was at a point in time, whenever, if you're looking at their cash, no, from a cash perspective, you don't need it. But in the future, again, as a part of this planning process, you never know when you might need it. So we start to initiate that conversation even when things are really good with the bankers. One kind of piece that we look at too is we like to at least have a 5% of the revenue as a potential to be able to draw on for the line of credit. So that's at least a starting point for us that I like to look at as well, because some clients may come to us and already have one, but maybe they don't have enough. And maybe we need to go back to the bank and say, hey, what do you need from us in order to extend this line of credit, and walk through that process with them.
Yeah, and Joe, you asked a good question. If you mention onboarding and when we would start, it would be right away. And the first conversation could be really easy if you're introducing yourself to the banker, to be saying, it surprised me for a company like this that they don't have a line of credit. Let's talk about that. And our general rule, and Hannah, I agree with you, having that amount you can draw on, but we would in general say it's the same size as your cash reserve. The ones who are resistant, line of credits when you're not using them are not very expensive. And so I would usually make an analogy to insurance. You pay for insurance assuming things aren't going to go poorly, but you're prepared in case they do. same kind of thing of having this line of credit in place. Maybe it costs you $1,000 in fees and other things, but now that you've got it in place, and to Hannah's point, we've all worked with clients before that didn't want one, and right as it gets in place, they desperately need that line of credit. And just the difficulty when things turn down and have a couple losing months in a row and then go talk to the bank about needing a line of credit, and it's just a totally different conversation. You're very much on your heels really wanting this line of credit, and a bank's not in a great position when they're looking at a losing business, and now they're looking much more at what do they think a failure could look like, versus Hannah's client where they're like, you don't need a line of credit, you could pay this off 4 times tomorrow if you wanted to. Perfect, of course I'll give it to you, kind of thing.
Yeah, I think back to my personal life when I bought my first house in North Dallas. And for those who are unfamiliar with the North Dallas soil, it's not a question of if you're going to have foundation problems on your house, it's when. And I remember that was the first thing I set up for myself, because I viewed it exactly the way you did, Tom, is this is some insurance about if I ever need to sell this house quickly and they find foundation issues in the inspection, I need to have this little backup plan, stopgap, however it is you want to visualize it, already in place, so that I'm not having to come out of pocket for a foundation repair that I can't afford. And that's kind of how I've always thought about that line of credit. Is it's just that little peace of mind that if it goes bad, you've got a nice little, kind of safety net there to kind of get you through some liquidity issues.
Yeah.
Anything else on cash before we start talking about dynamic forecasting?
I don't think so. I think we covered the main things.
I think we're good. Tom, if you want to hit the slides forward a couple slides, I think we've got a couple ones here on. There's one more there. Yeah, that's the one. Okay, so creating a dynamic forecast. And this is something that we at Summit Anders are very, very proud of, is our insistence and reliance and general love for a dynamic forecast. Before, just definitionally, how would you define a dynamic forecast?
Yes, I'll take that. A dynamic forecast is moving. It is ever evolving, much unlike a budget. So a budget, we said at the beginning of the year, it stays stagnant. A dynamic forecast, we're having a conversation about every single month, looking at our actuals compared to where we said we were going to be and making adjustments accordingly.
Well, I love that. I love that idea too, of the difference between the static budget and the dynamic forecast, because I will go back and with my clients and find, hey, let's take a minute here and let's just compare, especially like midway through the year when you've had a few months of things changing, and say, we thought we were going to be here and turns out we're here. Let's acknowledge the gap between where we thought we were and where we are, good or bad.
Yep. And as Hannah described, in our process, at least once per month, we're updating that forecast. And so, 12 times during the year, and then more frequently as things happen and they're saying, oh, I did just lose that big customer. You can quickly change it at that point, but it's not something that gathers dust and you're just, people put out of their mind.
So in terms of identifying non-financial revenue drivers, what are some things, and I'll start with Hannah here, because, Hannah, you have a number of different industries that you work with. What are some non-financial revenue drivers in some of the industries you work on?
Yeah. So for my lawyers, I guess I'm thinking of trying to pick an industry specifically and look at what their revenue drivers are. We're looking at the amount of working days that we have in the month and how many hours we can fit into that and what our expectation is for our billable attorneys at that point, even some of our paralegals that can bill as well. So we're essentially working our way back into the revenue number to determine how we got there. Who billed how many hours, what they were billing for, was their fixed fee work that we did within that revenue number, and determining how we can then get to where we want to be. And does that mean that we end up hiring another attorney that can potentially bill and get us to the revenue goal that we need to get to? Or what does that potentially look like? Or are we overstaffed for the amount of billable work that we have? That's another conversation that we have as well. So those are so key in determining how to forecast your revenue. You've got to understand how you even make your revenue, what factors go into that.
Tom, what about you? Same question.
Yeah, so I'll pick a different industry since Hannah picked one that was service and hours based, which is a good one. I've got one that does transportation, so they deliver things. So miles become a really important one, and they've calculated that it's about $1 to drive the vehicle a mile. So when you put in insurance, gas, vehicle, people time. So they measure things like empty miles. So as they're returning from somewhere empty, that is not revenue they can generate. And so they know that, 5,000 miles last week cost us $5,000. The other really important thing they use it for is what they call loaded miles. And those are the ones they're paying the drivers for. They do an average per driver. And what they know is when that number gets too low, their drivers are getting smaller paychecks and they start having problems with their people. And so that becomes a couple numbers. Of course, they drive the financial results, but these guys are very much more miles focused when they look at numbers. And so each week we're looking at kind of those type of metrics. And then percent on time is one that really measures, that they know can measure customer satisfaction. When that number gets too low, you're not delivering things on time, customers are complaining about it.
Mm-hmm. So let's talk a little bit about how you use those non-financial revenue drivers to actually create a revenue forecast. What can you both kind of talk through the process of how you do that?
Yeah. So for us in the example that I gave, we do look at how many available hours that we have in the month. We also take into consideration paid time off. If some of our employees have that, if there's holiday hours, we're looking at those available working hours as well. And then working back into the expectation for each of our attorneys and our paralegals and making sure that that piece is aligned. So that way, by the time we do all the math and all of that, we understand what our actual revenue capacity is based on those factors.
Yeah. Ours is similar. Stick with the same industry. They happen to deliver things that are cold. And so there's a seasonal part of their business. In the really colder winter months, they have a little bit less delivery. People aren't quite as worried about things thawing in a normal delivery truck as they are when it's, 100 degrees outside.
Mm-hmm.
But our measure when we come up with sales metrics are on those miles and loaded information. So you'll come up and say, if you want to be this big, but we'll look back at where were we last year. And if, for example, you had an owner saying, well, I want to grow 20%, you've got to change those other metrics. Is your loaded miles percent going to go down because of that? Or are you going to really drive that many more miles? If it's an unrealistic growth, you can turn and say, you don't have the people or the vehicles to do that kind of work. It just puts it in the language that they can understand, and then also they can control. They don't have a lot of control over the dollars themselves, but they do have control over what's actually going out on the road and being delivered.
Mm-hmm. Well, and that's a great point too, that leads into that understanding your pipeline point there, which is once you've created a revenue projection based upon these non-financial revenue drivers, now you've got to make sure you've got enough sales pipeline to be able to fill that void. What are some techniques that you can use to kind of visualize that pipeline?
Yeah, I can start with this one. We break the pipeline into two main things when you talk about revenue. One is what do you already have under contract or committed revenue? Mm-hmm. So let's say you're trying to hit like $500,000 in a month, and you can look and say, already under contract and projects planned, I've got, say, $300,000. So I can count on that, and I can sort of poke at that a little bit and see how realistic that is. And then the other is what's coming in for prospects. And in that part, usually people are looking at like a customer relationship management system. And you got things in different stages where you can say, I've got someone who's verbally given me a yes or a certain amount there, all the way back to people who have just made contact in that. And so within there, you can use historical data and what they think about the current to say, well, then what do you think that's going to turn into in terms of real revenue going forward?
Yep. I would say many of my clients are the same way. We're looking at this from a likelihood of maybe high, medium, and low. So maybe we're looking at 3 different scenarios of what revenue outcomes could be, or maybe we're even looking at it from a likelihood percentage. I have one client that we look at for the first 3 months of forecast. We look at it from a 95% win rate or better, or then from 6 months out, we look at 65%. So there's multiple different ways that we look at our pipeline, but just the fact that you need to understand what the likelihood of things closing, and again, kind of going back even to the state of the economy and talking about that sales close time, that's going to play such a role in understanding your pipeline. And if that tends to extend, make sure that you've got that factored into your pipeline forecast.
Well, it's a great point that both of you made too about validating those numbers, because I work with a nonprofit here in Albuquerque where there's a historical amount of it's the percentage of kids who decide to go to the school that I sit on the board of. And we actually had a situation this year where our historical close percentage is were about 5% less than they normally were. And it gave us, not only did it lead to a decreased revenue pipeline, which led to a different set of problems that we had to solve, but it now gave us something to talk about with our development team of, is there a larger issue here that we need to be aware of? Historically, 25% of the kids from all of these feeder schools said yes, and this year it was only 20. So it does give you a really interesting kind of place to start conversations as well with your sales team about what larger trends are going on in the industry.
And that's a great point, Joey. With many of our clients, we are measuring sales close cycle and probability of success or actual close percentage. And so over time, as you're watching that go down, can bring up a really good question. Is this an anomaly? This 5% is a one-time thing, or are we coming into a time when it's not? And we'll talk about how the forecast could play out. Hey, if this was really true, what does it mean in terms of how do we try to get this back up, or do we have to get smaller to be able to handle a smaller student body or whatever your group size is?
Or, a smaller workforce if we need to take a look at capacity and those types of things. And that leads into the last point here, which is protecting your gross profit, which we can probably cover pretty quick and move on to another slide here. But that to me just means understanding the relationship between your cost of goods sold, whatever's driving the revenue, whether it's people, whether it's trucks, whether it's miles, and making sure that you're maintaining that relationship in your forecast moving forward.
I agree.
In terms of improving inefficiencies, and this is something you should always be looking at improving your efficiencies, whether it's a downturn or an upturn, but what does that mean to y'all in sort of the day-to-day operations of a business?
I think it can mean a lot of things. I think that you can look at this from a processes perspective as well. That's something that we really like to drill down into in the onboarding process with our clients, is really pop that hood, see what's really going on within each individual department, whether it's the billing, the AR piece, whether it's the sales team, whether it's your biz development team. You want to be sure that you understand those processes so that way you can apply technology in some of those in a lot of cases, or maybe it's somebody that you really need to train up and spend more time with. But that's one of the things that comes to mind in terms of improving those inefficiencies.
Yeah, how much quicker, how many more opportunities you can get through if your sales cycle is shorter. And one, I think people need to look around and see what their competitors are doing and what's possible. But I'll give an example for us. When we talk to a new prospect, within the first phone call in an hour, we can give someone a price. We've talked to many other, and accountants are very analytical people. We've talked to many who will say, hey, I charge a prospect for a study, and in 4 to 6 weeks, I can come back and say, I understand your business, and I'll do that. If time's important to the prospect coming in, you got a 1 hour versus 6 week time frame. The amount of volume that we can get through with people. And some of those people say no, but I'd rather get to know much more quickly and move on and not spend the resources on it. So looking just at that process, like Hannah said, there's a process piece, and just saying, is it predictable and is it as efficient as possible to where I could speed it up, can really help you.
Tell me if you hit next on there. Yep, there we go. Another thing that I think is important at all points is making sure that you're, doing things like software audits. The same thing that happens in our personal life happens in business, right? You look at your subscriptions, you're like, I didn't sign up for Amazon Prime, did I? And then you're like, oh, no, wait, sure did. Just forgot to cancel 6 months ago. What are some things that you guys that y'all like to do with your clients? And Hannah, we can start with you here on this to kind of facilitate that conversation about looking at their fixed costs and how to improve that on the cost side.
Yeah, so we're definitely looking at those reoccurring costs, making sure too that I had a situation specifically with the lawyers who she didn't realize until we started looking at this, that she was paying for like 5 licenses for their software for people who had been gone out of the practice for many, many years. So that saved her thousands of dollars over the course of the year by looking at that and making sure that that was in alignment. One piece I want to throw in there, I have an insurance background. This is one piece that I don't think businesses look at enough, is making sure that you're looking at your insurance policies as well. One thing a lot of people don't know is that each year, typically, as rate renewals come out, there is an automatic inflation adjustment that happens on your coverage. And sometimes, if you've not looked at that over the course of many years, your coverage can sometimes be more than what you need because that 3% has just stacked up year over year over year. So you just want to make sure, and there's also opportunities for you to be underinsured. So you want to be sure that you're looking at that, but you also want to be sure to shop that around as well. Make sure that you're getting the best rate for those things. And maybe it's something you've not looked at in a while.
Yeah, one very simple format that we often do with clients is if you list all the vendors and then in columns, you've got months and how much is being spent. And Hannah, to your point, we've often had clients who will look and say, what do you mean I'm still getting charged for this? I canceled that, is what they think. And so then they find out that it didn't get canceled. Trimming fat also is underutilized resources. I mean, so if you look at your team and Hannah talked about the capacity this team could produce. If they're not producing that capacity, it's worth looking and saying, do you need that many people? And might you consider switching out an employee for a contractor that you only pay when they're actually used? And people often balk and say, the contractors say $125 an hour, hiring an employee is cheaper than that, but you don't pay the contractor when you're not using them and you continue to pay the employee.
Yeah, I would imagine if you took the employee's effective rate and looked at it from that perspective, if it's severely underutilized, then yeah, that's going to be more expensive than the contractor in the long run.
Yeah.
I think the last piece that we wanted to talk about here is being proactive with your receivables, which we've kind of talked about already. So we can probably keep moving on to the next stage here, which is probably the most fun part of our job, right? Which is kind of playing out certain scenarios. And if you want to just hit the next, bring all those out into the corner, we can talk about them through those types of things. There's a few scenarios that I typically love to play out with clients. And it starts with a best case, middle case, worst case scenario, right? Where we kind of pull all of these different levers to say like, well, what happens if you do get that big client? Here's what this is going to look like. What happens if you lose that big client? Here's what this is going to look like. And what happens if we land kind of right in the middle? What are some things, and Tom, we can start with you on this. What are some things and some scenarios that you like to play out with clients on a regular basis?
Yeah, and I just love that it's scenarios because it makes it so much easier when it's on paper. The hard decisions become easier, like what would you do? But if you take that first one, a big client. So let's say that is 25% of your business going down, to actually say, okay, this is what happens to revenue. We're say losing this much money, and you can see where cash might run out if we didn't do anything. Hopefully that motivates them to do something and say, so what would we do? I would probably propose, let's take the people who are on that client and they would be gone. Nobody likes that, but you would get that decision around, okay, yes, that, or I would switch some of these people out. But having that decision made in advance, and then if it really happens, makes it so much easier to say, we already planned this out. Why would we not go ahead and execute the plan that we already took care of?
Goes back to that preparation versus panic conversation we were having earlier. You're prepared for the conversation instead of panicking about it when it happens.
Right.
Hannah, what about you?
Yeah, I think planning is the biggest thing, just playing all of those scenarios out, seeing what that looks like. But I think there's another side to this too. So we can lose and we can pause a big client, but also what if we get a new big client? What does that look like? Do I have a hiring plan in place? Do I have the infrastructure in place? Am I going to need to immediately go to contractors for a short term because my hiring cycle takes me 6 months? And if this closes in 3, do I have enough people? So that's another scenario that I love to play that out too, because I typically try to see the glass half full. I like to look at like positive scenarios as much as I like to look at negative. So adding that in there and making sure you're planning for that upswing as well is important.
A couple things that I like to do on some of mine, playing with utilization of things like PMs and other traditionally non-billable people is not an easy way, because you've got to convince your clients then and present it properly to where they can understand the value of playing for some of those people. But playing with utilization, what happens if we add an extra hour or two to everybody's billable expectation? Or on the other side, if you're worried about retention, can we afford to maybe move down to a 4.5-day work week or a 4-day work week or something similar to that front? The other thing too that I wanted to get some thoughts on is the importance of playing out the balance sheet. I had a situation with a client earlier this year where we were facing one of those situations, losing a big client and having to look at our team. And the client was like, man, I just feel like we're moving backwards. And what I did was I played out 3 years of a reduced revenue business and right-sized their employees and said, look, we're actually going to do better as a business at 2.2 million than we were going to do at 2.6, because we right-sized the team and we proved it out through the balance sheet over 3 years. So there's so many things I think we can do and business owners can look at to have those types of conversations. And to your point, Tom, see it on paper and prove it out that way.
Mhm. And you mentioned something earlier, Joe, that's really important. If you get lots of customer deposits, it's really easy for a business owner to say, sure, my accountant comes in and says that things are really difficult, but I look at my bank account and see a really big number in there. And
Right.
so as we look at the balance sheet, when you show, okay, now you have to actually do the work that you got prepaid for. And you sort of mentioned the owner, you don't get to bill them a second time. They already paid you once. And watch how that cash can go down can really change that view. And I think cash just speaks so well to them. If you're saying you've got a runway at the current rate of 6 months, 9 months, something that's a really short time frame to say we have to do something here. And for some, luckily, even just showing that cash is going down makes them move. Unfortunately, for others, they have to watch until cash really gets tight before they'll really do something.
Right.
Yeah. And I love playing out the balance sheet for a long-term cash flow perspective too, because it really does just kind of open your eyes to what that looks like and what the effects of and what you're going to be feeling in the next few months based on the decisions you're making today.
Yeah.
We've got about 10. Oh, go ahead, Tom.
Let me mention just one more. That sales decreasing, I think, is so important. And I've had a number of clients where we're in a moment now where the pipeline's fairly weak for people. For a long time, sort of my resounding thing that they're probably not listening to me anymore on is you have too large of a team, right? Your team's underutilized, your utilization's down, you're wasting money. With one of the clients, I went and said, look, I want to build a scenario for you with what we call the smaller house. You should be smaller. And I said, the way I'm going to do is I'm going to take your low utilized team and I'm going to cut some of the people. And so I came back the next week and had cut 6 people and showed them how it was better. It finally got them engaged because they said, well, I wouldn't cut Joey and Hannah. I would have to go cut these couple people. And all of a sudden they came back actually with more people and said, but these are the ones I would do. And it surprised me the way it worked. But once we actually put people's names on it and showed them, here's how you can make money at the level that you've been selling as opposed to what you've been hoping to sell, it actually got them to make a decision. But it was, like I said, it was really easy on paper. If they wanted to switch out Joey and Hannah for 2 other people, piece of cake. I can bring it back next week and show you different numbers with that very easily.
I think that all kind of ties back into going back to the dynamic forecast and protecting that gross profit at all costs and understanding where you want that to be, because you can start to see these squeezes a lot earlier too, whenever you start to see that gross profit go down based on capacity, utilization, things of that nature. So making sure that you just got a really good understanding of what that is and what you need that to be for your business and where you want to go with it is so important.
And what I've done with a couple clients, Hannah, is I've created like a trigger point where I've said, hey, we're going to look at this short-term cash flow projection. And at week 10, if we're less than this threshold, that's our trigger point at which we execute the plan that we've talked about. So now we've got a lag or a leading indicator that we're looking at. And as long as it's above that number, we haven't reached that point. But the second it starts creeping below, 2 to 2.5 months out, that's when we know, hey, it's time to make a decision. We've already put the plan in place and we're going to make the decision now instead of 2.5 months from now when we don't have cash.
Yeah. You may have seen Debbie ask a question, are we using Giraffe to play out these scenarios?
Yes.
And I would answer yes. Yeah,
yes.
That's what we use.
Yeah. I will say there is one exception. Giraffe works well with Xero and QBO. It doesn't play particularly well with other ERP systems. Plan Guru is a good option for that. I also think Reach is developing some sort of forecasting tool where if you can get it from that ERP system into Reach, then Reach will be able to do some of those dynamic forecasts as well. But I think that's still a few months away.
Yeah. Good. Are you ready to move on to?
I think so. Yeah. And I think, we've got about 10 minutes left here. And where we wanted to spend, at least maybe the last little bit of time here, Tom, is hearing some story time from you, because we were talking in preparation for this about, a lot of this is, well, what happens when things are bad? But I wanted to talk about what happens when things are really good. And you mentioned a group that you've worked with in the past that, grew from, about $1 million a year to quite a bit more than $1 million a year. And I wanted to talk to you about the process of how you did that and how you kind of moved them through that trough to recovery to a massive, massive expansionary phase in their business.
Yeah. And in terms of numbers, this has been a fun client to work with. So they were less than $1 million. I've worked with them for 6 years and they'll be a little bit above $80 million this year. And that's been a progressive year on year, huge amount of growth. It's a couple of owners who have then grown the company from around, I think, 7, maybe 6 people when we started working with them to where they're 200 and something now. And I'd point to 2 things that they did. Focus was one of them. And so they are in the federal government space and they work with 2 specific agencies. But I remember early on, they had a salesperson who was saying, hey, there's this little bit of commercial work. So early on, they were doing sort of everything, including federal work. We could expand this commercial space, and came forward with a proposal, and here's what we could do to go after commercial. And the owner, to his credit, said, you know what, he personally is a veteran. We're going to focus on federal. That's where the growth is going to come from. I see the other as a distraction. Ended up shutting that down. At the time, it seemed questionable. As we've looked back, that focus has been great because they've been hiring lots of people who are really good in the government space. And then the other thing is they really understand what they're good at doing. And one example of this is they've often had people coming and saying, we should have a bigger bench. We're growing so fast. This is really painful. We go win work. We have to hire like 15 people. It's chaos and really stressful during that time. And the owner has said repeatedly, this is what we are good at. We're really good at staffing projects, and we're not going to hire people to sit around hoping we're going to win work. When we work, that's when we become really good. And our peer competitors are trying to do the same thing. We just do it better than them. So I saw those 2 things. Where are we going to play, and what are those key strengths that we're really going to focus on during that time? And it seems like just continue to hammer on that same nail that has made it work has allowed them to keep repeating the same success and grow an incredible amount. It's been really fun to watch them do that, while I watch others sort of struggle and get, I would say distractions, probably the biggest thing I've seen with ones who haven't done this.
How did you handle, obviously with government type work, there is a bit of a industry or some other type of concentration risk exposure. How did you handle that, and how did you diversify within that niche so that they didn't have too much exposure?
It's a great point, or a great question. The main way they did, so they do have exposure to all the federal work, but they are both a prime contractor in some places and sometimes a subcontractor. And that has helped out quite a bit. And so they will go out and get some of their own work, but they're also known in the government space where they've got some peer companies that when they get work, they turn and hire these guys to do that kind of work. So it's mainly those 2. They also have a mix of time material base plus fixed cost base. So they've got enough things that are mixing around that one thing doesn't really get them caught in there. And the time material, you always know you're going to make a certain amount of money on that. The fixed price gives you the opportunity to make a lot more, but it brings more risk. And so having that balance in there, that I would discourage them, and did, from all going fixed price, because it's where you can make the big bucks, because it's also where you can really lose yourself in those things.
Especially if you get lost with, not hitting the deliverable, and now you're just eating into that fixed price profit that you kind of baked into your business model. And
if there's another phase coming, that you really want to make this person happy, so you're chasing after potential future business and losing your shirt in the process. There's a whole bunch of things that can go wrong there.
Last question on this. How did you kind of help guide them through the culture side? It's easy to do the numbers, but it's a lot more difficult to find the right group of people to help you grow with. What were some of the conversations you were having with them about guiding the culture side of the things and making sure they were putting the right people in the right seat?
Yeah, that's a great question. So they decided to do a remote company. And there were 2 things I was encouraging, since we're also a remote company. And one was the owner didn't necessarily want to spend a lot of money on things like company retreats. And that was one that I was often saying, even being the finance guy, and they got expensive when you have 200 people, to say, yes, but this is the only time your teams are getting together.
Right.
And they do government work, and they will all acknowledge that government work is not very exciting for the employees do. It's technical development kind of stuff. And they have employees saying, I want out, because this is just, the government moves at a certain pace and this drives me crazy. So they try to pay people well, but then the retreats are the thing that when you're remote, to keep them tied to this company. Versus, right, when I work from home, I could really work anywhere. And so they want something that says, no, I really like this company. And the other is simple things like we have them with divvy cards with a budget for their technology, similar to what we have within our company. And funny enough, the employees see that as a benefit. But each month they say, I've got this much that I can spend on technology. It saves the company from making decisions. Like someone calls and says, can I get a chair, a desk, a monitor? They don't want to field those kind of questions. I'll just give them money to do that. But that's one that the employees think is kind of cool. It's like I get this divvy card and I sort of get free money, even though they're spending it on work things. So those are a couple cultural kind of things that they were doing.
Very cool. Well, thank you so much for sharing, Tom. I think that gives me a nice framework. And Grant Cardone and his 10X has nothing on the Tom Waddleton
Yeah.
and his 80X.
Yeah. I wish this was my normal client, but I do have clients who are successful. This is my golden child. Okay. Do you want to walk through these guys? I know we're a little short on time, so I'm going to get through these quickly.
Mhm.
It's really like this cleaning up your house. And so that attitude, and I'll come back to the leader not panicking. What is the attitude within your company? And I'm hoping that it's something that says we are a dynamic, flexible, we can get this done kind of company. And if not, you as a leader need to have that attitude and make sure that your team does. The focus I mentioned my last example, good times or bad, what is it that your company's going to focus on? And if, as a leader of that organization, if you're not setting that focus, you've got a scattered organization that's really hard to get things done. I hope that you're very vision focused. In difficult times, the ones who can look out a couple of years and say, I can see where we're going, but this is a difficult time, do so much better than people don't even know where this is going. And then if it's hard, you're saying, why do I even stay here? I can't see something long term. And then Joey, in the last one, you talked about culture. That is so important to kind of say, are people in the place where they need to be? Are they willing to be vulnerable when things get scary and communicate that I don't know where I am so that I can help them and guide them in that direction? So those are just some really key pillars that are in there.
Well, perfect. Thank you, Tom. Thank you, Hannah, for taking an hour out of your day to talk with us about, the goods and bads and fun times and not so fun times of preparing for the future, which, as we all know, no one knows what the future is going to hold. I used to tell clients all the time, if I had a crystal ball, it's going to be a lot easier to do this, but we don't. So we've got to guess and make our best educated guess and create a system and a thought process around doing this and then test and validate. So a couple things on education here to mention. We've got Jody Grundon's book, Digital Dollars and Cents, the Virtual CFO's Playbook to Help Digital Companies Create a Financial Roadmap to Success. I have read this entire book cover to cover. You're welcome, Jody. There's a nice little thing here for you to grab a copy today if you'd like one. I think we've got a couple other things here too. Our merger story from how Summit became Anders Plus Summit, which we're still living in that, but it's been a great journey for us so far. And then I think we've got one more thing on the Virtual CPA Success Show, which sometimes, occasionally, they have me pop on against my better judgment. Surely there's got to be someone more qualified to talk
They're
about this stuff than
advertising
me.
with you. Look at a good-looking guy in the picture.
Oh, I can't wait to get that picture retaken at the retreat in a couple weeks. Anyways, I think that's it. We'll go ahead and wrap up the webinar.
Thanks, everybody.
Awesome.
Thanks, y'all. Appreciate it.
Yep. Take care.
All right, we'll see you.